Hello. When a corporation is formed and or a party contributes property to a corporation in exchange for stock, we should consider various checklists that deal with the transferor shareholders as well as the corporation receiving the property. Now, before we dive right into these checklists, it's important to understand the order of analysis. Because various issues in the checklists, you must determine an issue before. So there's 6 steps to consider, which each step has its own checklist. The first is calculating any gain or loss recognized by the transferor shareholder. That doesn't necessarily mean that every transferor shareholder will have gain or loss, but it's the first step that we approach. The next step is to determine the adjusted basis of the stock and other property received by the transferor shareholder. The third is to determine the holding period of the stock received by the transferor shareholder. Steps 4, 5, and 6 all deal with the corporation that's receiving the property. In step 4, we calculate the gain or loss, if any, recognized by the transferee corporation. You're going to see that the transferee corporation is never going to recognize gain or loss with respect to the transaction. In step 5, we determine the adjusted basis of the property received by the transferee corporation. And finally, step 6, we determine the holding period of the property received by the transferee corporation. In this video, we're going to examine step 1 since that is the longest step. Again, in step 1, we're looking at the transferor shareholder. We're looking at the party that is transferring property to the corporation transferee. So we're going to use this checklist to determine on formation or contribution being if the corporation is already in existence. We're going to determine if the transaction qualifies for non-recognition under Section 351 of the Code. Remember that 351 is not an elective section. If the transaction fits under Section 351, which is going to be determined in Part 1 of the checklist, it's mandatory. The actual code section says shall, not may. So that means that it's mandatory. Non-recognition will result, and even where there's loss, where most taxpayers would prefer to recognize the loss as soon as possible, the loss cannot be taken. Now note that Section 351 applies to transfers of property and not the corporation receiving the property. Again, when we examine steps 4 through 6, we're going to see that those checklists deal with the various consequences to the corporation. So there's 3 parts within Section 351A to determine whether there's non-recognition, and all 3 have to be met. The first is, do we have a transfer of property to a corporation by one or more persons? Now there's a lot of language in there that needs to be defined. If we meet this test, if we do have a transfer of property to a corporation by one or more persons, we continue in the checklist. What exactly does property mean? Property is not defined in the Internal Revenue Code. However, it is defined through various cases and revenue rulings. Property includes cash, inventory, accounts receivable, patents, and other know-how. The idea is that property is very broad, just like we've seen in other code sections. So even if you have an idea in your head, that technically can be considered property. Now the key here is that we're distinguishing property, all right? We're distinguishing property from services, because services are not applicable to Section 351. If a transferor is transferring services in exchange for stock, which you're going to see is the next requirement, that's going to mean there's going to have to be income recognition, and you have to recognize gain or loss. Now, stock issued for past, present, or future services, again, is not considered property. Therefore, it's not part of the transaction. If a transferor receives stock in exchange for both property and services, all the stock received is counted towards the control requirement under question 3 below. We're going to see various questions later on. What do I mean? Let's say that A is a shareholder, and A is going to contribute $100,000 of cash to a corporation. All right, $100,000 of cash. A is a shareholder, A is an individual shareholder because A is going to receive some stock, $100,000 of cash, and also $10,000 worth of services. The idea here is that if A just contributed services in exchange for stock, guess what? That's not property. However, cash is considered property under Revenue Ruling 69-357. Therefore, if a transferor receives stock in exchange for both property and services, all the stock received is counted towards the control requirement for later on. Now, the portion of the stock that's given for services, you're going to see that you're going to have to recognize you're going to have to recognize gain on that portion. However, the issue is that later on you'll see that we're trying to determine the percentage for purposes of getting control. Now, what if the value of the property is relatively small value related to the services? So what do I mean? Well, if we add up the $100,000 of cash and the $10,000 of services, the value of those items is $110,000. Now, just an FYI, as long as it's an arm's length transaction, which almost all the time in tax we assume, the $110,000 of cash and services, A should be receiving stock equal to the same amount. So unless you're told otherwise, we treat it as arm's length, and A should be receiving $110,000 of stock. But what if we reverse the situation? What if we said it was $100,000 of services and only $10,000 of cash? The idea here is that taxpayers were learning they could try to game the system by, instead of giving just services, they would give some cash, just a little bit of cash. Well, there, we add up and we also get $110,000, but you note that more than 90% of what's given, more than 90%, because 100,000 over 110,000 is more than 90%. More than 90% of what's given is services. So less than 10% is considered property or cash. In that case, when there's relatively small value, and the primary purpose is that the transferor is trying to make the exchange qualify, then it's not considered property. We don't even look at the $10,000 of cash. Property is not considered to be of relatively small value if it equals at least 10% of the value of stock for services. We give $90,000 of services and $10,000 of cash. Cash is considered property. 10% equals property. As long as there's 10% of property and 90% or less, it has to be at least 10% or more of property, 90% or less of services, you're good. You can apply the general rule which we talked about up here. However, if you're below 10%, which is what we have here, right? We have 110,000, less than 10% equals cash, which is property. In that case, we cannot apply this rule. A transfer means that all substantial rights in the property must be transferred to the corporation. The idea here is that under the DuPont case, there can't be any leaving of ownership from the original party. All rights must be transferred. If you don't transfer, it looks more like a lease. Corporation is defined under Regulation 301.7701-2B. And just so you know, S corporations are subject to this rule along with C corporations. S corporations being small business corporations. We do not meet this rule. We do not meet this rule, meaning that we do not have a transfer of property, so there's no property, and there's no corporation it's going to. Then we stop, and guess what? The gain or loss in the transaction must be recognized. 351A does not apply. So the next requirement is solely in exchange for stock in such corporation. Is the property transferred solely in exchange for stock? Again, we've gone through question 1. The way these checklists work, you've gone through the first question. We have transfer of property in exchange, to a corporation. We have transfer of property to a corporation. On the other side, Is the transferor solely receiving stock? If so, we continue. Stock does not include stock rights, warrants, securities, non-qualified preferred. Anything other than stock will be considered boot. Now, 351A, Section 351A is a non-recognition rule that does not apply when boot is there. You'll see later on that Section 351B, though, might still provide non-recognition if you do receive boot. Now, note, an assumption of liability. What do I mean? Let's say that A transferred a building to the transferee corporation, and on the building, there's a liability of $100,000. And the corporation is going to assume that liability when the corporation receives the building. This could potentially be considered boot. There's two special rules where that happens. But the general rule is that it's not considered boot. But there's two possibilities, and you'll see that in Section 351B checklist, which is Part 2 of Step 1. If we do not have solely in exchange for stock, then 351A does not apply. However, you still might have 351, but we're not done. You have to consider Part 2 of the checklists. That's in Part 2 of Step 1. Now notice that if we fail question 1, we don't get non-recognition. We do not get non-recognition. We don't get 351A or 351B. The transferor takes a cost basis under Section 1012, and there's going to be recognition of gain or loss unless you can find something outside of 351A or 351B. Question 1, we have a transfer of property to a corporation. If we meet that, we continue. Question 2, solely in exchange for stock. Is the transferor just receiving stock? If we fail that, we have to go below. But we continue in the checklist to question 3. And immediately after exchange, such person or persons who are the transferors are in control of the corporation. This is the key element. This is what makes the non-recognition rule happen, because you have the ability to control the corporation and do with the property as you see fit. It's as if you're moving property from one pocket to the other. Well, not literally your pocket, but you're moving money from one pocket to the other. That's the money, not the property, the money. You can't fit a building in in your pocket. So we have to meet the control. If you have met question 1, transferring property to a corporation, you meet question 2, solely in exchange for stock, and you meet question 3, guess what? The transferor does not recognize gain or loss. You do not recognize gain or loss under Section 351A. To be in control, what is control? We have to define that. It's 80%, at least 80%, equal, 80% or more. It can be more than 80%, but it has to be at least 80% of two things. Notice, I say and. There's two things. All stock of the corporation, and the second thing, all voting stock. All voting stock, because as many of you are aware, there's different types of stock out there. Some have voting rights, some do not have voting rights. A lot of types of preferred stock do not have voting rights. If you meet that control requirement, you're good. In determining the control requirement, if a corporate transferor distributes part or all of the stock it receives to its shareholders, it's still part of the control requirement determination. Many of you are probably thinking of some interesting examples. Now, one thing to note is that if you're forming a corporation and you're doing it with a group at the same time, you're going to meet this 351 because everybody together, remember that the requirement states that person or persons are in control. If you're all doing it at the same time and you're forming it, which means you all added together have 100%, unless somebody is a service provider, you take it all into account, and guess what? You can get that 80% control, 80% or more. But what if the corporation's already in existence? Well, some of you might be thinking of ways to avoid tax by the transferor, because when the corporation's already in existence, it makes it difficult. Well, let's say that we have A, B, and C, who are all individuals. 3 different shareholders, 3 separate shareholders. They each own 1/3 of a corporation. D comes along and tries to get 20% of a corporation. Okay? exchanges cash for 20%. The issue is, does D meet 351? The answer is no, because D only gets 20% of ownership. But what if D contributed with A, B, and C? Let's say A gives $1, B gives $1, and C gives $1. And again, let's say D is giving 20% worth, which we'll just say is $100,000 based on the value of the corporation. Well, the way the test works is, and let's say they all give it at the same time, we actually sum up their ownership percentage. A, B, C, and D all own 100% of the corporation after this event. You look at before. The key is you look at before and after. This is a way that people were getting D, who would have been subject to taxation. Well, actually, D wouldn't have, because D is contributing cash and there's no gain inherent in cash. But if D contributed property that had lurking gain, then yes, D would have to recognize the gain for only that 20%. But if all of them give something, then they all have 100%. You compare before to after. If one of the transferors in the transfer group receives a relatively small percentage of stock as part of the group, that would be A, B, and C. They're all getting a relatively small percentage. They're all receiving a relatively small percentage of stock for the transaction. They're only getting $1 worth of stock. If they each get a relatively small percentage as part of the group, you add everything up and you get $100,003. Then the percentage that goes to A, B, and C will be disregarded. The property transferred will not be considered a relatively small value if the fair market value is equal to or in excess of 10% of the fair market value of stock owned or to be received. A, B, and C each provided at least 10% of the value of the stock received total in the transaction, they would be fine. But that's not the case here, so it doesn't work. Another issue is what happens if, let's say that A, B, and C originally form a corporation. They form it. A is going to transfer $100,000 cash on January 1st of year one. B and C, though, are going to transfer $100,000 worth of property each on May 31st. The issue becomes, are we going to group these two together as one transaction? Because if you look at all of them together, then they're all part of the 100%. However, if we look at them separate, then A has 100% ownership. B and C, let's say each owner, since they're each giving $100,000, each one afterwards is going to have 33%. B and C only have 67%, which is less than 80%. So B and C, guess what? They fail Section 351 if we did this separately. However, under the regs, you're not required to do simultaneous exchanges. And this makes sense because parties don't do simultaneous items out there in practice. However, under the Intermountain Lumber case, the idea is that if there's a prearranged binding agreement, then that will be respected. The idea here is that if the parties agreed beforehand, regardless how long it takes, that they would be all doing this as part of an arrangement where A is contributing $100,000 cash, B and C each contribute $100,000 in property, but again, it's all part of the same arrangement, even though it's later in time. It will all be considered part of the same transaction, and that's when you look at the immediately after, at that same time. Now, there's obviously some limitations to this. The IRS will see right through this, substance over form. If you wait too long, 5 years, let's say, then the IRS is going to scrutinize that like crazy. You gotta be careful. We call this the binding commitments test. It's really everything under the third test. You fail the third test. If you do not have immediately after the transferor or transferors have at least 80% control, then guess what? You fail Section 351A and you don't get non-recognition. Now, if you don't get non-recognition under 351A, you might be able to get it under 351B if you failed requirement 2, but you met requirement number 1 and 3. So if 1 and 3 are met, but number 2 fails, then we got to look at 351B. Then we have to look at 351B. But if you fail requirements 1 or 3, if you fail either one, you cannot get 351A or B. And then what's the results? You must recognize any of the realized gain or loss as part of the transfer, which, remember, you're looking at the amount realized, which is the cash or constructive cash or fair market value of non-cash property received, which is going to be the value of the stock received or other property received in the transaction. It's what you're getting. The amount realized is what you're getting, minus the adjusted basis of the property you're giving up to the corporation. That gives you your realized gain or loss, which must be recognized. So under 1001C, you must recognize that. The transferor will take a cost basis and the stock, which is going to be the fair market value of it.